Also joining us is Lincoln Ellis, Managing Director of the Linn Group. And we've got Tom Lee, the Chief U.S. Equity Strategist at JPMorgan Chase. Gentlemen, welcome. And Tom, I'm going to kick things off with you because we just talked to a trader on the floor of the NYSE, and they say there's a rumor out there about a rescue bailout package for Greece. If that actually plays out, what is that going to mean for the tone of the markets when we kick things off on Monday?
Well, Carol, without question, resolution on sovereign debt and inflation also, for that matter, are really important to investor psychology. I'd say that what we've learned in the last 2 weeks was a lot of trades were I think a lot of hedge funds and a lot of investors had the same trades on, the same type of risk profile. And over the last couple of weeks, we've seen that sort of risk pull in. So really getting some resolution would get people thinking, well, look, now that we've had some of these things resolved, where am I going to sort of reallocate my capital? And I think you're going to have a chance for some risk assets to recover.
Well, let me bring in Lincoln here and ask you what you think. I mean, you have been concerned about the sovereign debt overhang. Do you think, just because there are rumors in the market out there, obviously doesn't mean anything, do you think we continue to look at these problems with various countries throughout the rest of the year?
Yeah, I mean, it's absolutely clear that we will continue to have issues like this pop up, and issues in the U.S. with the state side that Nouriel was talking about in your earlier segment. But Tom's absolutely right. It's important for investors to note that, in fact, it wasn't the retail investor that had positions on in this market. It was the hedge fund investors. We saw that with the very light volume for half of the rally that happened for most of '09. And so to see this kind of turnover with many people positioned very similarly is not unusual. But yes, these problems are going to be persistent, and they will continue to produce road bumps throughout 2010 and well into 2011.
John?
Tom, what do you think? There are so many headwinds out there, and a lot of people come on the show and say, look, take your pick. I've got 10 headwinds, and one of them's going to hit. What's your outlook for this year?
Matt, first of all, rising markets need a wall of worry, or in this case, we've got a wall of worry and a wall of conviction. I think as we kind of seen in the past couple of years, investors, especially when they started to think about the global landscape, have gotten a lot more sophisticated. So I think we may have continuing problems for sovereign debt out of these smaller countries in Europe. But I just don't think it's going to necessarily derail a U.S. recovery. And as you know, for U.S. markets, ultimately, it's really going to be, do earnings delivered by companies driven by a high-quality recovery, not one that's cost-cutting and inventory. And as you know, that the factor here is really the U.S. consumer. Is housing going to reach a nadir? Are we going to get our arms around the mortgage issue? And if we can do that, and we see a sort of a rebound in consumer spending, it's going to be a very high-quality recovery.
They got to have a job. They got to have a job first, right, Tom?
Yeah, we need jobs. That's right. And I will tell you, for the first time in a long time, I think you could look at the January payrolls report and actually believe that the quality was actually a lot better than the headline. In this case, we had the participation rate up, but the unemployment rate fell. We saw manufacturing turn around meaningfully for the first time, as well as the service sector. And I think the fact that hours worked is creeping up shows you that we're kind of starting to really strain the existing workforce. It's going to be just a matter of time before some industries really have to unleash some hiring.
I think we're missing the elephant in the living room here, because we just spent about 10 minutes talking with Nouriel Roubini, who we talked about the sovereign debt concerns outside the United States. He said, though, we got to look here in our own country, and he's looking at that looming budget deficit, how we're going to get our hands around it. The state of the states, I mean, that's really problematic. Lincoln, how is that going to hold back this recovery?
Yeah, so it holds back the recovery in terms of some issues that face both the state and federal governments later on in 2010 and 2011, particularly as it comes to tax issues. If you listen to what Tom was talking about, a lot of what his recovery thesis is predicated on is this recovery in consumer spending. And I'm sorry, but we just don't see it. The largest consumer credit contraction since World War II continued unabated again this afternoon, a couple more billion out of the system. And while some of that may be increases in personal savings and things of that nature, that produces a very strong headwind for the kind of consumer-based consumption patterns that we've seen in the earlier part of the 2000s. So what we have, and I'll just leave you with this little anecdote. My father, who budgets for a small school district in up in New Hampshire, said that they have cut that budget north of 35% for the last 2 years, and they're going to cut it again another 30% this year. because the tax revenues aren't there. The actual towns are in crisis already.
Tom, what do you make of those points that Lincoln's bringing up and our concerns about the debt, the growing debt nationally here?
Well, that's definitely a mouthful. I mean, one, large deficits crowd out private spending. So, it's not healthy for the 5-year, 10-year outlook for the U.S. to run large deficits. I think that's a structural issue that's got to be dealt with. In the near term, though.
But is it just a structural issue? I mean, it's a significant problem, Tom.
It is, but if you look at sort of major turning points in this economy, especially coming out of recession, you do typically face fiscal situations very similarly. But the one thing I'd point out is I've heard a lot of people talk about the consumer and the contraction of credit. I think what people forget is you have to remember that a lot of the payments consumers make today are amortization of their credit cards or in consumer installment debt. In other words, there's a level versus stock issue here. And so as they make these payments, you're starting to see amortization of their debt levels, but consumer credit balances are not falling as quickly. So the point being, you could actually have consumer spending actually increase as they're starting to buy new durable things that require installment payments, but their actual balances will fall. Auto loans is an example, like where they're making payments on a SAR level of 18 million, but they're buying cars at 11. So the 11 million is contributing to growth, but the consumer credit balance is falling because they're paying off loan balances when they were buying cars at an 18 million rate.
Tom, what do you think about the moves we've seen in some of the commodity markets? Let's talk gold specifically.
Well, it's kind of, I think the movement in gold, and especially its sort of fall with the rise in the dollar at a time when people are worried about sovereign debt and inflation, I think it may show you how crowded a lot of these trades really were. I think people sort of had a risk trade. They were using the dollar as a funding currency. I think the next leg of the rally when the correction's over, and maybe we'll be lucky, maybe Friday was the end of the correction, or today was the end of the correction, I think investors are going to really look at risk markets where the external risks are diminished. And I think right now the biggest risk, at least when I talk to investors, seems to be they don't want to buy equities in regions where there's risk of inflation. So I think you're going to find people looking at markets where there's not inflation. And, really what comes to mind are some of the developed markets in the U.S. in particular.
Lincoln, I want to jump in and ask you a question related to what's going on with gold. Also, we just got some data from the CFTC, record shorts in the euro. Of course, that's going to affect what's going on with commodities. But if there is some development in Greece, I mean, won't you see a big snapback in the euro potentially, and also maybe some of these commodities?
Yeah, you sure could. I mean, the euro trade has gotten very crowded. It has been the trade, I forget the French word for week, but certainly the trade du jour for most of those people who were piling out of both legs of the funding piece of the carry trade, the yen yesterday and the dollar today. As it pertains to gold and commodities more broadly, we think that a lot of the commodity complex, as expressed by the larger indices, the CRB and things of that nature, have probably seen their tops for this year. We think that the demand component on a global basis is just going to be very, very anemic. And this risk that Tom talks about, particularly in emerging markets, is very much out there. And that, too, will be a headwind because a lot of the commodity-based consumption comes in those necks of the woods, as we saw most of the price of copper and oil driven a lot by Chinese imports over the course of the last quarter.
Ask you, though, I mean, you've got an outlook on the S&P, I think, for 1,300 by the end of this year. That's about a 24% gain from where we are, roughly. We just talked to Nouriel Roubini. He thinks that stocks are going to be basically flat this year. You still holding on to that target?
Yes, that's right, Carol. And, when you think about one-year periods, you have to be somewhat tactical. Think about relative value. Mm-hmm. Something that I think is very important. High-yield bonds are a very important signal for relative value on an equity. And today, 39% of stocks have an equity free cash flow yield that's above their bond yield. Now, at this point in the cycle, investment grade and high yield actually look fairly valued, or actually maybe somewhat cheap. And historically, this difference was resolved by equities rising. And in fact, when we looked at almost 15 years of data, whenever this ratio is above 35%, mm-hmm. okay, and it's 39 right now, stocks are higher 6 months later 89% of the time. So
but 24% higher, Tom?
Well, the average gain is actually around 9% 6 months later. So 24% in 12 months, frankly, is actually consistent with a 3% GDP recovery.
Okay.
Something like at least $80 in S&P earnings, and I'm very comfortable thinking, well, if we can achieve that, we could see 1,300.
Lincoln, let me just quickly get your target. Just 10 seconds here, but I want to see how it relates to Tom's. End of the year, S&P.
Yeah, up 5%. Biggest headwinds, the U.S.-China G2 structural problem.